In the alternate version of problem 10-2, Hillside issues a bond issue of a total of $1.1 million, 9% contract rate of interest, 15-year bonds dated January 1st, 2016. They pay interest semi-annually on June 30th and December 31st. They happen to receive an issue price of $950,524. We're asked to prepare the journal entry to record the bonds issue. Now, we'll look at this from Hillside's perspective. When they issue these bonds, they're going to receive cash. Cash is an asset. We're increasing it, so we'll debit it. The amount they receive isn't $1.1 million. They receive a little bit less, so we'll debit cash for $950,524. Since the amount they receive at the issue date is less than the par value, that means these bonds were issued at a discount. And we can look at this. The contract rate is 9%. That's the actual cash payment of interest they make. Because they were issued at a discount, meaning less than the par value, we know that the market rate has to be something greater than 9%. Couldn't tell you from this information exactly what it is, but it's going to be something greater than 9%. And it makes sense. If others with similar risk are paying greater than 9%, then if Hillside's trying to issue some bonds with a 9% interest rate, they're going to have to take a little bit off the front in order to entice people to purchase their bonds. So they're going to give a discount up front. Our discount on bonds payable, we're increasing it. Discount on bonds payable is a contra liability account. Liabilities accounts have a normal credit balance. Since it's contra, it's going to have a normal debit balance. So discount on bonds payable is going to be increased with the debit. It's going to look at the difference between the par value of $1.1 million minus the actual amount of cash received of $950,524. So we'll debit discount on bonds payable for $149,476. We have to credit bonds payable for the full amount of par value because this is ultimately the amount of cash that we'll have to pay at the end of the life. So we'll credit bonds payable for $1.1 million. If we looked at our balance sheet at this point, we would see bonds payable $1.1 million, and from that we would subtract out discount on bonds payable of $149,476 to leave a carrying value at the date of issue of $950,524. We'll see later how that will change over time. Next, second part, we're asked for each semi-annual period, calculate the cash payment, the straight-line discount amortization, and the bond interest expense. Keep in mind, we can't just leave this discount on bonds payable there permanently. We're going to have to figure out how to lower that over time. I'm going to start step by step with these different items. Let's first figure out what's the cash payment related to interest that they're going to make each semi-annual period. We'll take the par value of $1.1 million, multiply the semi-annual contract rate of 4.5%. May look at this and say, no, that's not correct. It says 9%. 9% is the annual rate. We pay interest, or Hillside pays interest twice a year. We have to take the annual rate, divide it by the number of periods in a year that we pay interest. That's 2. So 9% divided by 2 means semi-annually, or every 6 months, the interest rate is 4.5%. 4.5% times $1.1 million means every 6 months Hillside makes a cash payment to its bondholders for interest of $49,500. Now, normally what you're used to is, well, that's interest expense. That the actual contract rate is what my interest expense is. We've got a problem here, though. Hillside didn't receive $1.1 million up front. If they had, then this would have also been interest expense. They received a little bit less. In fact, $950,524. They received $149,467 less. We have to do something with that. It actually increases the cost of this particular loan because they didn't get as much up front as what they're going to have to pay at the end. This discount is going to increase interest expense. Well, we need to find some reasonable way of how to attach that to each period, and we're going to use the straight line method. And the straight line method of amortization of our discount works very similar to the straight line method you dealt with fixed assets. Just take our total amount of discount that needs to be amortized, divide it equally amongst the number of periods, but we're not dividing it by 15 years, we're dividing it by 30 semi-annual periods. Mine, we're paying interest semi-annually, so we're dealing with this bond on a 6-month basis. 15 years times the number of interest payments per year, that's going to be 2 per year, means there's 30 semi-annual periods. 149,476 total discount divided by 30 periods means every single individual period we're going to have straight line discount amortization of $4,983. Then we'll look at these. Again, I mentioned before that the amortization or the discount is going to increase the cost of this particular bond because they received less initially than what they're going to have to pay back at the end of 15 years. So we'll take our cash payment of $49,500, add to it the $4,983 of discount amortization, meaning every 6 months, June 30th, December 31st, the true bond interest expense, the true cost of this particular bond is $54,483. Keep in mind that's the semi-annual interest cost. Part number 3, we're asked to calculate total bond interest expense over the life of the bond. We did the individual every 6 months. Here's what it is. We want to look at the whole entire life. What's the cost of this particular business? You may ask, this doesn't seem too challenging. Take the number before, multiply it times 30 periods over the 15-year life, and I'm finished. You can do that. Rounding is going to give you a little bit different answer, but I'm going to attack it a slightly different way to prove out this number a slightly different way. So first I'm going to look at what's the total amount of cash that Hillside has to pay over the life of the loan, life of the bond. Again, 30 semi-annual payments of interest of $49,500. That's the amount they have to pay every 6 months. 30 times $49,500 means total interest payments of $1,485,000. They also have to pay back the par value at maturity, and that's going to be $1.1 million. So $1.1 million of par value plus total interest paid of $1,485,000 means that they pay a total amount of cash over the 15 years of $2,585,000. Compare that to the amount of cash they received up front. So subtract $950,524 from $2,585,000. And so over the life, we can say that comparing the amount they have to pay to the amount of cash they receive up front, the total cost or interest expense to be recognized over the life of the bonds is $1,634,476. So pretty hefty cost here. Let's look at another portion of this. It asks us to prepare the first 2 years of an amortization table using the straight line method. So let's start working on our amortization. I'm going to cheat a little bit just to decrease the amount of this time that you have to watch this video. And I'm just going to look at initially where we start at the beginning and 2 periods. You can handle the other 2 on your own. So let's look at this at the very beginning. When they first issue this particular bond, the total amount of unamortized discount is $149,476. Okay. The carrying value, remember I said that that's going to subtract from bonds payable on our balance sheet, on our amortized discount is going to subtract from it. So our carrying value is $950,524. That's simply just our $1.1 million minus our $149,476. Every single 6-month period, because we're using straight line, we're going to equally amortize or lower the amount of unamortized discount by $4,983. Remember, we took the whole entire discount of $149,176 divided by 30 periods on our slide before that said we're equally gonna lower our discount by $4,983 every single period. So let's start to do that. 6 months in, at our first interest payment of June 30th, 2016, our unamortized discount is going to decrease to $144,493. That's our initial discount of $149,476 minus the amount of discount we're going to amortize of $4,983. Therefore, in this situation, our carrying value actually increases. Think about this. We have less discount subtracting from our par value, so our carrying value is actually going to increase over time. So our carrying value of $950,524, add in the amount of discount that just was amortized of $4,983 equals $955,507. I can do this another way and say par value of $1.1 million minus our unamortized discount of $144,493 equals $955,507. I'm going to go through this rather quickly. You can prove it out on your own. December 31st, 2016, we're going to lower our unamortized discount again, subtract out another $4,983 and leaving it at $139,510. It bumps our carrying value up even more to $960,490. So we look at this, we have a decreasing amount of unamortized discount over the life of that particular amount that's going to subtract from bonds payable in order to raise up our carrying value. At the end of the 15 years, the carrying value would equal the par value. Not going to work through all the calculations, but trust me. Our next point asks to prepare journal entries to record the first two interest payments. Now I'm going to cheat a little bit and just do the first one again to reduce the video time, just to give you a little bit of practice. So on June 30th, 2016, we're going to have bond interest expense. And if you go back to a little bit in this video, remember how I identified that every single period is going to have an interest expense cost of $54,483. So we're going to debit bond interest expense of $54,483. In addition, we said in our part 2 that every single period is going to have a cash payment of $49,500. That's the amount of interest they're actually going to pay. This is the cost. That's how much they're paying. And we just calculated that by taking the par value of $1.1 million times the semi-annual rate of 4.5%. Now, there's a difference between these two, and that's the amount of discount that we're going to amortize. Remember how we identified that we're amortizing an equal amount of $4,983 of discount every single 6-month period, and we can calculate this two different ways. We could say $54,483 true cost minus the amount paid of $49,500 equals $4,983. Also, we can take the total amount of unamortized discount divided by 30 periods. We've already worked through those calculations, so I won't do it again. Important point here, though, is we're crediting discount on bonds payable. Remember how it's a contra liability account. It's increased with a debit and decreased with a credit, so we're reducing it each period. So we're going to credit discount on bonds payable for $4,983 in order to round out our journal entry.